What's going on, everybody?
Hello. Welcome, everybody, to the first live stream in May.
Oh, yeah.
Almost halfway done the year. Looking forward to the summer. We'll wait for a bunch of people to get on here.
No Justin Timberlake jokes.
Hello, everybody. Musa's on here. Right on. Well, what is going on, Charles? Good seeing you. We hope everybody is enjoying the weekend. Enjoying that sun. Today we are going to be talking about the advantages and disadvantages between multifamily real estate and single-family real estate. And there's a lot of questions that we get around this topic specifically, so we wanted to break down how this works so you can kind of align your goals and make sure that these type of real estates are actually aligned with your goals. So a lot of people, what they do is they'll come to us and say, I want to get into multifamily, and we'll tell them about it, and that might not be what they're looking for, or they're not really situated to be able to purchase single family. So sometimes multifamily works better. It really is dependent on the actual situation. So we wanted to break that down for everybody. We'll wait for a few more people to get on here, though.
Mm-hmm. Yeah, we actually had a conversation with a CMHC rep the other day, and she mentioned that in terms of their books on the insurance side, they're doing way more business on the multi-unit residential side than they are on the single family side. So it just goes to show that we've seen a huge shift in like the target property for people who are buying right now. A lot of stuff that we see coming across our desk is multi-unit, some sort of 5 and up building. I think it makes sense when you look at where the market's at right now. When you're looking at single family homes, not even duplexes, going for $500,000, $600,000, $700,000, and you take a look at some of these multi-unit buildings, going for maybe $1 million, some of them under $1 million. A client right now picking up an 8-plex for like $812,000. So that's pretty decent, $100,000 a unit. It just makes sense. Why not get 8 sources of income or 5 sources of income even on the lower side versus having one single family home and maybe stretching it into a duplex. So I think that's really the big reason why we're starting to see a shift into the multi-unit residential side.
Yeah, I think you're definitely going to see more buying pressure on the multi side as well. It's just it costs too much per unit to purchase a single family property as an investment anymore. And as it becomes more difficult to be able to qualify, we're starting to see a lot of people utilize the small commercial product, which is allowing you to purchase real estate as long as you have significant down payment and the asset cash flows itself. So one of the things we obviously wanted to get into first was just qualification and income to qualify for assets. So I guess I'll talk about the commercial side of things. In regards to commercial lending, as many of you know, we qualify a purchase based off of the revenue of the property and the expenses that the property has as well. So we look at historical expenses, usually what the seller is going to be providing to a buyer, or if you already own the property, then your historical expenses based off of the notice to read your financials that you would have had for your company. Primarily depending on the unit size, between 1 and 4 units, there are banks who will qualify these properties at around 1.15% debt service coverage ratio, which is decently aggressive, and it goes between there and 1.25. The qualification is more or less based off the property itself and less on the income that you currently make, which is definitely advantageous to business owners or people who are looking to get into real estate and don't show a whole lot of income on their taxes.
Yeah, multiple advantages there. You're taking that debt servicing pressure away from yourself. It opens up your debt a little bit on the residential side. And when we say residential, we're talking about a 1 to 4 unit property. It all comes down to your personal income and your ability to service any debt on the application. In some situations where the client might be buying a property in a holding company on the residential side, you still do have to debt service your own debt with your own income and any properties that might be in the holding company. So, if you had 4 or 5 properties in your personal name and now you're looking to start up, a portfolio in a holding company, you got to debt service those 4 or 5 properties that you have in your personal name, plus any other properties that you may have in the holding company. So, if you're getting up +5, maybe you got 2 or 3 properties in that holdco, you got to debt service them all with your personal income. On the A side, we're looking at tax proven income. What do you show on your tax returns? Are you business for self? You're looking at a 2-year average. Are you hourly with non-guaranteed hours? Basic stuff here, like 2-year average again, and then salary and full-time hours. We can use that guaranteed income. But for our business for self guys who are looking to qualify, if you write down your income, definitely makes it a lot tougher for you to qualify on the A side, depending on where you write it down to. So you're looking at, some sort of B side purchase. On the B side, you got rental rates as low as 2.95, but, more likely in the 3% area. If you're true business for self and need to use some sort of stated income product, you're probably looking at 3.25 to, 4%, depending. And you got to pay your fees on the B side. So there's 1% lender, 1% broker. When we take a look at qualifying under the commercial side and the small business side, like Josh said, you're under that small commercial and commercial, you're already paying a broker lender fee. Why not look to get it done on the small commercial side, pay the same fee and get a better rate? Maybe you're getting something in that 2 to 3% area instead of that 3 to 4% area. So a little bit more attractive rates there. It's a lot easier to qualify. You're qualifying based off of the building. The residential side, like I said, qualifying off of your personal debt servicing.
It can also give you flexibility.
Yep.
So instead of having a B lender taking a debt service or what's it called?
Well, instead of looking at your whole portfolio of rental properties, when they take a look at on the small commercial side, they're going to take a look at the cash flow of your existing properties, but they're really just taking a look at that single building and does it sustain as an asset on its own? It's heavier reliance on your personal net worth and liquid capital on the commercial side. What do you have to support the building? Whereas on the personal side, on the A side, you do have to have minimum $100,000 really for most A products. Even Scotia has, somewhere between 10% or 50,000 for everything above a $500,000 building. So most A products require some sort of net worth. So a lot of the advantages just lean going towards that small business side and, the flexibility it has and then what that does for a borrower.
Completely agree. And we had somebody post on Instagram asking if we could do it through secondary markets or smaller cities as well. You can use the small business program for smaller cities outside of Toronto. If you're looking at Windsor, Kitchener-Waterloo, London, places like that, you can definitely utilize that product. And this product is usually more effective with credit unions. And credit unions are primarily geographically focused, so it really depends on where your property is and what small business program that credit union has. But they're the ones who are gonna be able to give you the most flexibility when it comes to purchasing or using this type of financing solution. Mm-hmm. We have a few more questions. One on Facebook. On the B side, for mortgage lenders, are they more generous when it comes to accessing equity in a property? So that's a great question. As I was saying, if you go to a B lender, primarily you're in a fixed term. The majority of the time, you're in like a 1 year, maybe a 3-year term, depending on the type of B lender you go with. But 99% of the time it's fixed unless you're paying a premium to have an open term. So they allow you to, in essence, qualify for more because your ratios can be higher and we can use rental income in a different way as an offset. But when it comes to actually accessing the equity in your property, it's going to cost more to break the loan instead of maybe taking a small commercial loan and getting a variable term and then having the ability to be able to break it and access that capital.
Yeah, I wouldn't say they're necessarily more genuine or generous, sorry. Every lender, basically 98% of the lenders out there have about a $200,000 equity takeout limit, where when you're under that $200,000 and the more under you are, the more lenient they are with being able to give out equity and not really asking too many questions. Anything on top of that 200, or once you get close to that 200, the lenders are going to start to ask, they just want to know what are you doing with the capital. And it makes sense when you think about it. For one, $200,000 is a decent chunk of change just to be giving out to someone, free into pocket. The big concern for the banks are they going to go do something with this capital that is then going to add more debt to their portfolio and, technically increase the risk of them missing a mortgage payment. The more debt they have, the more things they got to allocate their capital to, the more likely they are to miss or be late on a mortgage payment. So they're really just looking out for their own interest and making sure that, we're not going to be putting the lenders in jeopardy. So that's what we ask. And, especially when we use credit unions as well, too, who, again, can be more generous in some circumstances, again, as long as the building debt service as well. Credit unions are pretty lenient in terms of what they're able to do. I definitely get, a lot more equity taken out with credit unions with much less questions asked. I'm doing a couple of deals right now where the clients are going to walk away with just over $1 million. And, basically they just wanted to have a written statement or just some proof as to where the funds were going to. By proof, they had a couple of renovations. We just showed a couple of spreadsheets and the lender was okay with that. So, it's much more lenient to be able to utilize the credit unions for some of these than it is going to a traditional bank. But again, it all depends on your application and how you're looking to qualify. So
also, one of the main differences between residential and commercial property is going to be your down payment requirements. So as many of you know, if you're buying an insured mortgage, either insured for a personal home or multifamily property up to 4 units, you can use either 5% or 10% down on the insured side, which is definitely advantageous if you are strapped for capital or it's your first few properties. It's going to allow you to be able to take on all the leverage while you're not having to put down as much money down on the properties. It does allow people to scale, but it also does come at a cost. There is a premium that CMHC or SAGN will charge you. It is built into the loan amount and amortized out over time, but it is a way to be able to have access to the full appreciation of multiple assets for the least amount of money as possible. Mm-hmm. Now, when it comes to commercial property, the majority of the time, most multifamily commercial assets are a minimum of 25% as a down payment. This is for a handful of reasons. One, the assets are usually bigger, and the banks, feel more comfortable with the larger down payment requirements. If the deals has some hair on it or it is a difficult deal, it is possible that sometimes they may ask you for even more larger of a down payment. We've seen between, I think 65 was probably the lowest I've seen requested on a multifamily in any sort of commercial loan. But at 65% loan to value, most banks are able to work through maybe some of the challenges, whether that be having vacancy or having issues with the property. You are able to mitigate the majority of the risk at a lower loan to value.
Mm-hmm. Yeah. On that commercial side, mortgage amount directly dictates the ability of the building, the debt service. So they're definitely going to take that look into consideration. One thing to consider is, the building, the purchasing building and what kind of state it's in. If you're looking to purchase a vacant building, it can be quite tough to get that done on a small commercial side because the underwriting relies so heavily on the income coming in from the asset itself. If you have an empty building and no income coming in, it's going to go right back to relying on your own personal income. So it makes it quite more challenging in that situation. I had a prime example. Clients were looking to refinance 3 single family homes that they had, but they bought them for purposes other than directly having a long-term rental income coming in. So they weren't too concerned with the rental income on paper, and it just didn't quite debt service where they needed to. So, we had to use professional corporation guarantees to help support the income and supplement it that way. So it can be a little more complicated on the commercial side if the building itself does not have great cash flow. Whereas on the residential side, it may be a little bit easier to qualify because you can use other income from other rental properties on the entire application as a whole to help offset some of the costs and get in that way. So depending on what the asset looks like at the time of purchase, it may make more sense to buy it on, as a 1 to 4 unit on the residential side versus a small commercial side.
For sure. And, one of the advantages of purchasing residential property is there's no minimum personal net worth requirements. Now, when we take an application and we run an application on the personal side with a bank, obviously they're going to see all of your liabilities and all of your assets. So they're going to have a decent idea of your minimum net worth. Now, sometimes banks are having at least $100,000 provable net worth. It can't be household goods, so it has to be either equity in a property or cash, savings, stocks, bonds, things like that. But most of the banks now are trying to implement some sort of net worth policy because they don't want people who don't have the cash purchasing multiple properties, or at least trying to slow it down. Whereas on the commercial side, there is decent weight given on your personal net worth, your liquid cash, and your availability to be able to, possibly cover some of the unexpected costs that would come up. There is no line in the sand saying you need to be worth this much to be able to buy this much. CMHC does have some requirements when it comes to liquid net worth for their product. I believe it's 25% liquid net worth of the loan amount they're going to be giving you, which can be a lot depending on obviously how large your building is. So those are kind of safety barriers in place, but for the majority of the time, purchasing residential real estate, you don't have those barriers to the market. So it's something to consider when you're looking at purchasing, something a little bit larger.
Yeah, definitely. And, moving on to the next kind of focus or point of focus would just be the down payment. What are you allowed to use for down payments and just the amount on the residential side, that 1 to 4 unit. Obviously, if you're looking to do some sort of insured purchase, if it was an insured home purchase with an additional unit, a legal duplex or triplex, fourplex, you do have the ability to put a minimum down payment down. So, if you wanted to house hack, you do have some options to get in for a reduced down payment. For 1 to 2 unit, it's 5%. For a 3 to 4 unit, it's 10% down. So that's one option. If you're looking to purchase a non-owner occupied, the most or the minimum that you can put down, is 20%. For this, in terms of sources of down payment, on the A side, there are a few lenders who don't let you borrow that down payment. First National is one of them. No gift. It has to be all your own resources. And there's a couple of the big banks as well too that do that as well. They just want to make sure that you're not over leveraged. Like you have the capital to be able to carry the cost of the house, any repairs. If the tenant were to lose their job or a pandemic hits and they just don't have the rental income to pay. Can you carry a couple months? So they just want to make sure that you have that liquid net worth. On the B side, they have the flexibility for the borrowers to be able to borrow the down payment. So you can borrow it from a line of credit. You can borrow it from a credit card if you wanted to, unsecured or secured line of credit, as long as you can debt service any payments that you may contribute to your liability. So if you go and put $100,000 on a line of credit, can you afford that debt payment that's going to be calculated out on top of the mortgage that you're going to get? So we have to make sure that that's a possibility. In terms of borrowing funds from a person, on the B side, you can family, direct family member, grandparent, parent, brother, sister is really what you're limited to. You can borrow some. Some B lenders may want a 50%, so half the down payment can come from gifted. The other half, they want you to have some sort of skin in the game, so some sort of your own capital. So they're a little bit more restricted on what you can do with, in terms of borrowing down payments. No vendor takebacks, and you're probably not going to be able to get away with an investor type loan if they're not coming on title for the investment property. Whereas if you look on the commercial side, they're able to work with vendor takebacks as long as the building is able to debt service it. You can do as high as vendor take back as you want, as long as their rental income can support the first and the second. We've seen investor loans be used before on credit unions. So someone who's not coming in on title, if there's a loan agreement in place and your personal net worth is strong enough, or you have a good explanation for why you got to borrow those funds, we've seen a credit union make those exceptions on the small commercial side. So there's definitely a little more flexibility when working on the commercial side for down payment.
Tons. Yeah. It's very difficult when it comes to residential real estate to be able to, well, you're not allowed to, you can't source a down payment from anywhere but yourself or a gift from a family member. So it's, you're a little bit kind of handcuffed when it comes to purchasing on the residential side. One of the things to also consider is going to be, the cost of owning these assets and acquiring these assets. When it comes to actually qualifying, we factor in vacancy and management costs for multifamily properties, which you might not factor into your overall calculations if you're purchasing just like a residential house. It can affect your overall qualification as well if their past management costs were decently high and you're purchasing the property. Even if you wanted to self-manage, we still need to use some sort of percentage to help you qualify for the loan. When it comes to multifamily property, some things that most people don't think of is you're gonna have to own a corporation. The total upkeep cost of that corporation, and you're gonna have to do the books. We highly recommend it. Well, you don't have to, but I highly recommend you do the books and run your commercial purchase as a business. And that way you can keep historical financials of the property, which will help the seller in the long run, but also yourself optimize your total revenue. Single family properties. Single family, the overall cost isn't overly expensive if you're just doing regular financing. When it comes to closing the actual transaction, the commercial lawyer fees can be more expensive than what residential lawyer fees would be. Sometimes substantially more expensive depending on the size of the building and property you're looking to purchase. Keep that in mind. Obviously, everything is bigger as the value of the property goes up, but they can be a little bit more complicated. We've seen clients who've had 5-figure lawyer fees for closing larger transactions, and sometimes it's a little bit of a shock. So definitely keep that stuff in mind.
I think one thing to kind of keep in mind when you go into the small commercial side is they now consider your personal profile or your holding company as a portfolio. So every time you purchase a property with that credit union, it goes into the portfolio. And one of the requirements of a small commercial purchase is keeping a net 1.25% DSCR on all the properties in that on that commercial portfolio that you have. So one of the things they're going to do every year is a yearly review. They're going to sit down, they're going to take a look at the books, and they're going to want to know what your numbers are. And if you aren't consistently keeping your portfolio at a 1.25% debt servicing, they're going to give you a warning and say, hey, look, if you can't maintain this, we're going to have to look at some other solution, or maybe potentially call a loan in a worst case situation, because that's their underwriting. So it puts a lot more pressure on to maintaining that property, making sure you keep rents up every year that you're allowed to. You're having your yearly increase in rental income. What does that look like if you're looking to refinance? Every time you refinance, you pull out a larger loan amount. Does that limit you a little bit more? If it's the building is just debt servicing, how much room do you really have to be able to take a refinance out? Whereas on the A side, the conventional side, again, if you can, and it's a 1-to-4 unit, you might be able to utilize your personal income a little bit more and the other rental properties that you have. Now, if you have a full portfolio on the commercial side, say 2 or 3 different properties, they're going to average that out between every property in that portfolio. So if you have one property that's under debt servicing, but one property that's just way over, maybe it's in the 2% area, they're going to allow you to even that out. And as long as you're keeping that overall 1.25 debt servicing, they're going to be okay with it. So there's a couple more requirements and just things that you really got to be on the ball with on the commercial side. Just make sure that you go over with your broker on the commitment and have a full understanding of all the things that they're going to require. Because it's small commercial, they're treating it like a business. So you got to make sure you're meeting all your targets that are set out by the lender.
It can be pretty cool, like offering these products and services. Obviously, when you build a relationship with a financial institution who's going to do this for you, usually they're able to offer some sort of credit line or over collateralize the assets that you've blanketed. We've helped developers and builders cross collateralize like a project to be able to give them like an operating line of credit. So there's a few things that you can do to utilize this. Obviously, there are some challenges to it, such as breaking the loans on all 3 of your properties at the same time. So there can be some upfront costs associated with it, but it does have some pretty great solutions. One of the disadvantages of it, we can tell you about all the great things, but disadvantage would be access to capital or changing your product. So if you want to refinance a property, and one property is unleveraged and and a bunch of properties have a bunch of leverage or more equity. If you wanted to pull some out or whatever, you'd have to restructure all of your loans. Or if you wanted a different product, you'd have to restructure your loan. You'd have to restructure the one you currently blanketed plus the one you're looking to take out and go with somewhere else. So setting it and forgetting it. A lot of guys we see doing this are optimizing what they currently have and then creating some sort of operating line or pulling the cash out and buy another building.
Yeah, I think in our next batch of videos that we'll be putting together, we're going to talk about portfolio lending and how you can maintain and manage a portfolio and the ways that you can use the equity. So that'll be coming out in the next month and a bit. So just keep an eye out for that, and we'll let you guys know when it's on the way out. But on the commercial side, like we said, if if it's a strong building and it has that cash flow coming in, it's a great it's a great tool to have in a portfolio. The small commercial itself, so there's two commercial portions. There's your small commercial, and then there's just your standard commercial portion. The small commercial portion is usually limited to one thing or another. It's either total loan amount for all the borrowers combined or some sort of door limit depending on the lender. So just kind of keep that in mind. You don't have unlimited access to it. There is a period at some point that they're going to push you over to the commercial side when that portfolio gets too big. But it can be a great way to get in and potentially just move properties around and manage them a little bit easier. And then once you start to get to that limit, from there, we can figure out how best to maneuver properties, whether it's you're moving specific ones with stronger cash flow to a true commercial so that they can better offset that slightly higher rate and leave those lesser cash flowing in the small commercial side. There's things that we can take a look at, but the commercial side is just so many key points and potentials to be flexible. I mean, really the big things just to understand is that on a commercial deal, you're looking at a 20 or 25-year amortization. You don't get the 30-year amortizations. On the small business side of commercial, we do have one lender with the credit unions that is able to do a 30-year am. It's very rare. They want that building to be able to debt service at 20, 25-year amortization because it shows the strength. You're not relying on amortizing it out. So majority of the time, you're going to see commercial underwritten at 20 and 25-year AMs and a 25% down payment. Yeah,
no, they're both great options. A lot of it comes down to capital. How much capital do you have available? The barrier to enter the market is obviously there for multifamily commercial property. If you don't have the cash to put down on the property, it can be decently difficult to enter the market unless you're looking at a secondary option. But when it comes to people who get the most bang for their buck, multifamily property, you get more units for less cost. You get more cash flow, less risk when it comes to not being able to cover your bills if you do have vacancy. Overall, the assets are much better performing than what's possibly single family homes would be able to give you for risk. So we see the majority of our clients who were in single family or duplexes last year, a lot of them are purchasing larger multifamily properties now to be able to mitigate risk and to increase cash flow, which is interesting. I don't think the trend is going to slow down, to be honest. I think CMHC is just going to be pushing out more money and they're going to be incentivizing people to do this. And we all know that decent rental properties is a mandate for CMHC at the moment. And they're pushing it hard because a lot of people, unfortunately, don't have access to decent rentals. So I think that's where the market's headed in the short term.
Yep. I think one quick point to touch on here before we get too close to that 30-minute mark is if you are buying commercial and it's a mixed use, so there is true retail, some sort of component to it, just do your due diligence on those tenants. The lenders are going to ask some very specific questions, especially right now with the lockdowns and the business shutdowns. If it's some sort of business that's unfortunately deemed non-essential right now, some lenders are we're going to want to take a look at a history of numbers, show me what the past revenue is. And, if you don't have the evidence to support, you may have a harder time getting the financing on that. They may not consider that rental income or may use some sort of ratio percentage of that based off of a calculator that they have. So, make sure you get the full understanding. Have those tenants applied for any of the government help? They deferred any of their mortgage payments? Are they up to date? Have they been late? All these details are going to be extremely important for us to know and for us to be able to paint a picture for the lender. The lenders are going to ask these questions regardless. So just make sure you have these things. You've asked these questions. Get your 2 to 3 years financials from the building so that we can show and help support. If you're one of the tenants is shut down previously right now, but it has 3 or 4 years or even 5 years of really strong financial income coming in, that might help the situation versus not having that data and being able to show, like I said, they may not consider it or use a reduced amount. So do the due diligence, make sure you have all the details and a full understanding of where those commercial tenants are right now.
For sure. Right on, guys. Well, we are at 29 minutes. We're trying to keep it under 30 minutes, for everybody's sanity. If you guys enjoyed this video, we really appreciate you if you went and hit the subscribe button on our YouTube channel. We're trying to grow that following and give you guys better content. If you have any ideas or have any topics you'd like us to talk about, just put it in the below or shoot us a DM. We'd be happy to chat. Thank you all so much for joining us today. Go enjoy the rest of your Sunday. Enjoy the rest of your weekend. We will be back next week to talk about 10 things that you actually didn't know could, put a speed bump in your closing, which is actually going to be probably one of my favorite videos we shot.
I think so.
Yeah. All right, guys, take care. Enjoy your weekend.
See you guys.
Bye.